Welcome back to another episode of Life with Mikey. Today, it's going to be real estate. What is going on? Rates are starting to drop a little bit. Rents in some markets have cooled. Investors are still on the sidelines. We're going to talk about today how to get cash flow and passive income in a world that feels very expensive. So we have some data coming at us. Mortgage rates just hit their lowest point in almost a year. And that shift could be worth hundreds of saved dollars in your pocket. So mortgage rates now are on average 6.29%. That's the lowest in the last 11 months. Now, historically, or at least for what we're used to, that's still high, but it is trending in the right direction. That drop just from 7% to 6.29, that can save you about $150 a month on a $300,000 loan. Home price growth has finally cooled in many metros. You are seeing corrections in some areas. In others, prices are still up. In the markets that are undersupplied, it's not moving the way it should. Rent growth, it's in some markets on multifamily, we're seeing it flat. In the markets that were pro-development, in others, like our state of California, we're currently underwriting our rent growth to about 3% annually. SFRs are around that same 3% mark. Home ownership in California, because it's more expensive here. If you have an $850,000 mortgage, so this is like your starter home in California, $1 million, you're putting $150,000 down. That's insane to say, but unfortunately it's the reality. At 7%, your principal and interest is going to be roughly $5,600, $5,651. At 6.29%, which is the new average interest rate, so that little bit of a drop, that's going to bring your monthly down to $5,248. So you're going to save about $400 a month or almost $5,000 for the year. So what we know, yes, rate drops are going to put more dollars in our pocket. What I'm hoping that we're not going to see prices scream up as rates come down, because then you're not saving any money. Everything's going to stay how it is. According to Redfin, they don't think we're going to hit true affordability until 2030. So they're expecting the next 5 years to be more of the same. But there is a way to do this, and that's what we're going to go over right now. We're going to talk about how to try to get rates down if you're going to buy, but I'm going to spend a good amount of time talking about real estate investors and how to get some cash flow and play this game when everything is elevated. So cash flow is not the goal. It's part of the fuel to get you to financial freedom. You have to understand the difference. So here's how to structure deals and be long-term so you can both win on cash flow and appreciation. The two models that we're going to talk about, build to rent, that's what I do. We're also going to compare that to single family, because I know a lot of the people that watch me and listen to our podcast, they're looking at purchasing homes. And so I want to try to make this work, whether you're an investor like me or you're getting into your first house, and go over how we do this. So here's my philosophy, and this is one of the traps that I think a lot of investors go down, is you either get cash flow or you get appreciation. And usually investors choose one or the other. And if you were part of my generation and you grew up with the book Rich Dad, Poor Dad, we became entirely focused on cash flow. The idea of financial freedom and only spending the interest that you make off your dividends or the cash flow that you make off your properties sounded amazing, right? You get all these investable assets, you get cash flow every month, you live off the cash flow, you never watch your net worth drop, and you don't have to work at that point. Working becomes an option, and that idea is cool. Here's the challenge to it. If you're young, you should not be focused on cash flow. You should be focused on appreciation or building your wealth. And what you typically see, the natural evolution of an investor from 20 to, let's call it 50s, you're usually entirely focused on wealth build. And then as you start gearing up towards retirement, you start wanting passive income more and more. And then you start seeing a shift out of whether it's growth stocks or appreciation play in real estate or however you're viewing your wealth build, and moving into purely cash flow. Here's the challenge. Cash flow should be a smaller return than appreciation. And so if you're young and you're entirely focused on cash flow, you are choosing a hypothetical 7% return where the appreciation could get you twice, if not 3 times that. So my view has always been this. I want to focus on appreciation. I want to build my wealth. But for real estate, cash flow is the lifeblood of the asset. So you can't neglect it. And so I've always looked at both. How do I get an asset that cash flows to a point where my asset is safe? And then I focus on appreciation and I focus on forcing appreciation. That's what we're going to talk about here. Right now in the rental market, here's the challenge, and this is why a lot of investors are not buying stabilized deals, which means a turnkey investment. That is you buying, let's say, an apartment building that is fully leased up, that cash flows. You're going to buy it and have an income producing asset. This is why a lot of those are not working right now, because a lot of properties are trading at a 5.5% cap rate. And cap rate basically gives you a forecast of what the asset is going to produce in income without debt. And so if you have an asset that is yielding a 5.5% cap rate and your debt or your cost to borrow is, let's call it 6.4%, your interest rate is higher than the cash that the asset can spit off. So now you have negative leverage. Now, why would people do that? There's 2 reasons. I think it's risky, but there are investors doing this. Number one, they're expecting rent growth to grow. And so over time, you will get to a point where your asset can pay the interest. So you might have a window where you are putting money into that deal until you get there. Another model that people do is adding value. This is a value add approach. This is you renovating or doing things to your asset to drive rents up. And then you will get into a point, hypothetically, where your rent actually covers your debt service. As you can see, that's risky. So this is why I focus entirely right now on development and why we're building apartments. Because in my market, if I can buy at the 5.5 cap, but my interest rate is higher than that, I'm negative leveraged. But if I build, I can build higher than a 5.5 cap. And we use a metric called yield on cost. That basically means however much the apartment costs, what will be the yield on that? And if you can build to a, let's say, 7.5% yield on cost, now the income from my apartment can cover my debt service. So I am not focused on yield at the moment. I'm focused on what my yield is going to be 2 years after I develop. Now I have an asset that actually pencils. Some of the things that you need to be mindful of right now: insurance and tax trends. That's going to be specific to the county, so you're going to want to pay attention to that. You want to focus on who your tenant is. A lot of people focus on families. The reason why is families usually have a little bit more stability, and when you get through your lease agreement, you usually see a higher percentage of people that renew, and so your turnover is a little bit less. So people focus on that. A big one that new investors miss on is how much supply is currently being added or about to be added after you. So you need to be focused on that. Are you getting into a market where you're about to see a lot of development? And if so, you need to make the calculation that that market might get oversaturated. And if that happens, there may be a point in the future where your rents are going to go down a little bit, or your occupancy is going to drop. So those are some of the things you need to look at. One thing that was interesting on SFR REITs, SFR REITs are showing a 96% occupancy, and they're seeing about a 4% blended rent growth. So it looks like the SFR REITs are performing pretty well. So maybe there's a case, if you're somebody who's looking at REITs, SFR might be a good option for you. So I would be checking into that. How to increase NOI in 2025. So what you're going to see is during certain times, you might have different strategies to grow your rent. I'm going to go over what we're doing and where I think you can add value today to potentially bring that rent up so that you have an asset that overperforms in a market where it feels like a lot of people are on the sidelines. Your profit is not just about rent. It's about what you keep. So you need to be focused on your net operating income. And we're going to go over right now how you drive that up when rates are high so that you can not just create value, but you can stay in a cash flow positive scenario. Here's some of the levers that I'm pulling, and here's some of the things that you should be looking at. Number one, when it comes to value add renovations, not all renovations are equal. You're going to see some things where you have to put a little bit of dollars in and you see a big impact from that. There's other things that you can do where you're putting a lot of capital in and you're not really seeing a big return from that. Some of the low cost, high return examples, paint. This one goes a long way. Paint a property and a unit with cool colors, and it actually brings a unit back to life. So don't sleep on painting. LED lighting. This is an easy one, and it actually helps. New cabinet hardware. Think about how basic that is. Put some new hardware on it. It changes the vibe. Resurfaced countertops goes a long way. Basic landscaping. Don't sleep on that one. Just put some cool landscape in. It is not expensive. It can change the entire look and feel of your asset. Stuff that usually flops. Here's the things that you need to be mindful of. A lot of people over renovate for their neighborhood. So if you're doing luxury appliances in entry level markets or a trendy design choice, that doesn't always add value because you may be outpricing the home for the market it lives in. You run a risk that you're going to put a lot of dollars in, you're not going to see a return back. So be careful of that one. A big one right now, I would say kind of the big trend is ADUs and conversions. So you can build or convert garages, bonus spaces in legal rental markets. You got to make sure you can do this. One new unit can double your income. So I would be looking at purchasing properties where that's an option. That could be huge. RUBS is your ratio utility billing system. RUBS is basically like splitting bills at an Airbnb. So if you're going to rent an Airbnb and you have 3 friends, you share the house and you're dividing the utilities. RUBS is a tool that landlords use, which basically means instead of you paying the water, gas, trash, you divide those by the unit size and head count and pass them to the tenants. That can add a good amount of revenue back to you. You have some ancillary income options. You have pet rent, you have storage units, you have reserved parking, you have Wi-Fi upsells, laundry machines, solar credits. Every $25 really adds up. Some of the ones on this one that we've seen, pets, having an upcharge for pets, we see that working. Storage units, we see working pretty well. Reserved parking as well. We don't see a lot of buy-in on Wi-Fi upsells. Laundry machines, you see this usually in older assets. If you have a laundromat in there or you have your washer and dryer, you can charge for doing that. Because we're builders, we usually put that in the unit and that's part of the rent. But a lot of people focusing on value add will do that. Development and repositioning. So this is another reason why I focus a lot on development, because if you get a property zoned and entitled, you can make the argument that you're adding a lot of value to a property before you even build it. So let's just say our San Diego project. We bought a duplex that was being rented out as an Airbnb. And so it sat on a 6,000 square foot lot. When we purchased it, I want to say we purchased it for like $1 million, maybe $1.6 million. And then we entitled it, which means the city approved a building on paper for us to develop a 32-unit apartment. Just going from a 2-unit duplex to being able to build a 32-unit apartment, a lot of people will then sell the paper or sell the project entitled so that you can go out and build it. That is a strategy to build wealth. We typically take it a step further and go build the asset ourselves. In that scenario, I'm running off of memory. I think that project cost us about $13.5 million to build. And then once it was stabilized, we were looking at a value of just under about $19 million. So that would be an example of how we are forcing appreciation through a development strategy. Now, on increasing NOI, if you increase your NOI by $5,000 a year and your market cap is 5%, that's $100,000 in value that you just created. So I think the move in 2025 is force appreciation, because that's something you can control. If you can control your return, it feels like you are actually implementing a strategy to make money, as opposed to just buying something, crossing your fingers, and hope the market does it for you. Moving away from development. Now, this one, I don't know if we're exactly in the time to do this, but I think we're starting to get close. So on single family, we're at a stall out. We covered this last week, where sellers are listing and then they're pulling their homes off the market because they're not getting what they want. On the multifamily side, you're starting to see deals actually trade at higher cap rates. If that continues and values of single family goes down or cap rates start to climb, I don't recommend timing the market, but you are going to want to start getting ready to act, because if you start seeing cap rates climb a little further, or in a scenario where we're expecting interest rates to go down, on multifamily, if interest rates go down, you should see cap rates follow. And if cap rates follow, that means values are going up. So I do think there is an argument, it's an assumption, that even without a value add strategy, if you can buy right now at, let's say, a 6 cap, and you're expecting rates to go down like the Fed is telling us, and that 6 cap drives down to a 5 cap, or maybe tapping into the 4% range, you're going to make a lot of money just by buying smart. So I think we are entering that time. But to kind of sum it all up, I would look for ways to be adding value. I probably wouldn't be risking negative leverage deals right now. You might want to put more equity down to give yourself some cushion. But I think right now the play is development. If you're not a developer and you like what I'm saying, look for developers. This is something my company does. We build apartment buildings, we build storage units for investors that want to participate but don't want to do the work. You don't have to invest with me, but there are groups out there that do what I do. Look at becoming a passive investor so you can grow your wealth in a time that I think is a great window to go in at. I've always been a believer that if people are on the sidelines, that is the time for you to go in. It just means you need to be smart, you need to be disciplined, you need to know what you're doing. So find an experienced group. I think this is a great time to be looking. I hope this was valuable. Leave a comment. Let me know what you guys are seeing. If you're buying right now, what you're waiting for. And if you found value, please subscribe to the channel, hit the like button. I will see you guys next week.